Hello everyone and welcome back to the channel. I hope that you guys are having a beautiful week. I just wanted to make this video really quickly because there was some great conversation in this week's class and of course in the chat that I feel like makes for important information in trading, right? Everybody online, of course, is pitching the next best strategy and the next best everything, and they're doing these really blanket statements based off of blanket information that I don't feel like has enough considerations to make it practical, probable, or even possible in some cases. So with that said, I'm going to go ahead and just review what's on my chart because, well, hello, I have to. It's a chart. It's what I do. Odd NZD, this is a trade we looked at in my morning classes on Tuesday morning. The indices weren't playing the way I wanted and I was a little late on the buy, so it is what it is. Needless to say, we found a really good couple of other trades as well. So this is Odd NZD. I'm going to zoom in. We'll refresh and kind of normalize this view a little bit. What I was seeing was a huge move down, a nice impulse candle, of course, a retest of that move, and we made a higher high, right? So we've confirmed that we had some time, and this is where we were sitting at the time. So in and around this blue line, 10 o'clock Eastern Standard Time was where we were at, and I knew that somewhere around this range, that right or wrong, we had some room. So I'm just breaking down this trade idea with you real quick because, well, it's what I do. It's a chart, so needless to say, I knew one way or another we had some room to at least hit our first take profit to kind of come up to this level. This was my major target, this zone, and kind of in between 2 and 3. And overall, we had a great risk to reward trade, potentially, right? Worst and best case scenario, we had about a 6.3 to 1 risk to reward ratio, best case scenario. And worst case scenario, we had like a 3.5 to 1 risk to reward ratio, which still makes this a really good trade overall, right? So, having said that, something that I was, as you guys can see, writing right here, difficult discussion point because this is really a better open discussion than me teaching and preaching to a camera. Lord knows I'm working on how to get better at that. But let's just break this down in my thought process with you, if I could figure out how to talk clearly. So whatever methodology you're using to find an entry, you find an entry. Of course, I'm pretty biased on my golden strategy. It works amazingly. It's changed a lot of lives. People use that as a confirmation or consideration with the other things they're doing, and they're doing exponentially well. So funded account challenges passed, 6 figures, grown, quitting their jobs, a lot of great things. And I know it's a process and a time, but I find mine with my way. So however you find yours, of course, I support it. I personally believe, as biased as I am to mine, I think most strategies have the potential to work as long as they have some kind of backing or mathematically sound principles. They have the potential to work with the right management. So however you found your entry, you have officially found an entry. What's next? You've determined how much you want to risk. So let's say you're doing a funded account challenge, you're risking like 0.25%. Let's say this is your retirement account or your 401k account. This is a bigger hedge fund account. You're risking, 0.25, 0.1%, 0.5%, 2% at the very most if you have the leverage, but whatever. Cool. Let's say you're doing this on some of those unregulated brokers. You're doing the grow it or blow it kind of concept, the high risk. I'm going for as much as my margin will allow. I'm going for 10% on this trade. I'm going for 15% on this trade, knowing you can only be in one at a time. Okay. If you're going those high levels of percentages, you can only be in one trade at a time most of the time. Again, depending on what leverage you have and what broker. But okay. So you've got your trade. You found out how you wanted to make your entry. You've got that determined. You found an entry. Now you've determined how much you want to risk. Cool. That's 2. Number 3, now you need to determine where your stop loss is going to be before, and this is key, before you try to determine your lot size or if it's a good risk to reward trade. Because if you don't know where your stop loss is, you can't determine your lot size with any amount of mathematical accuracy. And if you don't know where your stop loss is going to be, you can't determine if this is even a good risk to reward trade based off of where price is sitting and where it's most likely to start to reverse or turn around. So like assuming best case scenario, worst case scenario, that's okay. Best case scenario, this only comes up to here. I'm not super banking on the risk to reward, but at least I'm profitable and I have time to protect kind of concept. We need to consider that. We need to consider, hey, if we're entering here, our most likely, turnaround points are going to be in around this, liquidity void in around this area. So is this enough room? So for example, if you were taking the trade right up here at the very top, you've already seen it turn around, you'd probably want to wait for a pullback, right, before you try to take an entry. So those are important consideration points, but that's not what we're here to talk about today. Again, step 1, you found your entry. However you found it, don't care. Step 2, you determine what you wanted to risk. Cool. We got that. We know that there's a lot of variables there based off of brokers, leverage, and other things. Cool. Step 3 is, where's your stop loss going to be? And that's really what I want to talk about today, because I feel like this is such a potentially controversial topic. Everyone on YouTube has this new strategy where they're using some software or some whatever to say, this is where I put my stop loss and this is how much accuracy I can have. And that's great. But those back tests and or forward tests, well, unless it's a live account, they don't account for quite a few things that I think are significant and I think are the reason why so many people are potentially losing. So before you decide to determine how your lot size is going to be, or even determine, should I take this trade based off of where it potentially can turn around and if it's a good risk reward trade, let's talk about some consideration points to maybe factor in, right, before you decide what your stop loss is going to be. So everybody, of course, wants a tight stop loss. You hear all the gurus say, well, all the best traders don't use a stop loss. That might be true for some, stock traders who just, forever buying and holding, or they are trading one direction. That might be true for some day traders too. Might be true for some options. It might be true for a lot of things. Having said that, the majority of duplicatable people, that's not the case. And I feel like too many people are saying, hey, I don't use a stop loss as a means to not back up their trades. But the reality is the few people who are successful at not using a stop loss, let's first bring this out there, they have a ton of self-discipline. They have key levels that they have the discipline to say, hey, at this level, I am going to close, and they're capable of doing that. Whereas some people, they hit this level and they get all kinds of mumble-jumbled in their brain and they're like, well, if it just goes a little bit more, or hey, the RSI is really overbought, and hey, it looks like it's about to turn around on the TDI, and we technically just crossed below this on the 1 minute, maybe it's time to turn around, and then they don't end up closing at their, considered point. So first things first, obviously I think you need a stop loss. You want to do things your way, by all means, you do you, boo-boo. But for this conversation, we're determining what are some things to consider when you do have a stop loss. If you don't want one, you do you. Then go off of reward and not risk. I have no hate or shade on that, because some of my most profitable times were when I was only considering the reward and not even really factoring in the risk. The risk was just the price I paid to get to the reward. I didn't even really mentally and or mathematically consider it in the same way I do now. So no shade there, by all means, you do you. But stop loss considerations. I've got 5 things up here. I could probably get 5 more, but just to simplify this really quickly, and we're going to go to the chart and kind of point some of this stuff out. People are picking stop losses because they want it tight. People are picking stop losses because they know that tighter stop loss means they can have a much larger lot size because their stop loss is really small. People want tighter stop losses because it makes them feel warm and fuzzy, because it makes them, they don't have to sit through drawdown. They don't have to be impatient. They don't have to wonder what's going to happen later. I get it. But if your stop loss cannot afford these things, to me, that's not a reasonable stop loss. And this, for me, again, not for anybody else, I can just tell you what I've done myself and how I have seen other people do, and some of the people I have helped to have some immeasurable success. These are the things your stop loss should be able to afford. So for the purpose of this conversation, I'm going to call it pips plus, right? So many people say, well, I only want 25 pips of a stop loss, or I only want to go for 50 pips. And hey, if you're only looking at pips, more power to you. I super support that. I get it. We all started there. There is no shame in that. Pips do matter. They do count. And that's how we all kind of measure this. But there are some other consideration points that we can, of course, discuss and learn and grow together. But if that's you and you're saying, hey, I want a 25 pip stop loss, I hope that you take your 25 pip stop loss and consider pips plus. And what I mean when I say that is, can your pips plus, is it going to consider pips plus spread, pips plus room for a gap, pips plus room for slippage, pips plus rooms for news and crossover, pips plus room for consolidation? We know what happens in consolidation. The market springs up and springs down. We know what the bigger players are doing. So if your stop loss is not being able to afford you what the bigger players are going to do to try to get you out, right, the other side of the market, then to me, your stop loss is not the most advantageous for your most long-term success. So just a couple of things to really show real quick. And now let's go back to the chart and talk about some of these, because the trade that we looked at is a perfect example of why this matters so much. Back to the chart, I've already kind of drawn up and marked out exactly what I was looking for. These are the actual price points, rounded numbers, I should say, to where my targets were going to be. My major target was in here, so I've already spelled all that out. This is, again, 1 hour time frame, Australian NZD. But let's zoom in. So 1 hour time frame. I'm going to zoom in, make it as super crystal clear as possible. Remember, we got in, this is not time exact, please don't be that silly person, but this was our 10 o'clock candle. This was approximately the price point that we were getting in, I was getting in specifically, and this is where we're at. So somewhere in and around these candles, we're in this trade, and we're in profit, not by a whole bunch. Okay, we can even measure that just to find out how much it moves all together, maybe 18-ish pips, give or take, right? Not having moved a lot, but we're in profit. We're moving and we're trucking along. This is New York time. This is session crossover. Again, still in the 1 hour time frame. This candle, I believe, is like 45-ish pips, give or take. 44-ish pips, there you go. This, at the time it happened, session crossover, actually looked like a gap. And I'm pretty sure it's not going to show on this platform. Here's where we were at. So it's not going to show exactly. But at this time, what it looked like was the close of the candle gapped down and filled all the way back up. So if this is a 45-ish pip candle, what you can assume, and again, every broker is a little different. Please don't, hang me to the stakes. But you can assume somewhere around 50, 70, 80, 90 pips of a difference between your bid and ask price. And what that means for you as a trader is you're getting knocked out in a pretty big loss on your take profit or your stop loss, again, depending on how your broker is executing that information and what kind of management or EAs and tools you have, just on this one alone. So you can see this was an overall good trade. In hindsight, 2020, you've got 200% return on risk on this trade. It is a beautifully, perfectly played out trade. Again, we'll pop to the 1 hour just to show that. Let me refresh, bring up the clearest view. We'll show you exactly. Here's from the entry. Here's that 3 fractals back, which is the settings we use, plus a little bit of a spring. That's 38-ish pips. This has moved a total of 80-ish pips. That's 200% gain on risk. That's 200% return on what you were risking. Cool. That sounds great. And that's not even the whole move, by the way. That's beautiful. That's perfect. But if you can't afford this because you got knocked out 7 times in this process, or because you over leveraged and you took too many trades, right? If you put your stop loss too close, you got knocked out. Let's again go back to that 15 just to kind of normalize it a little bit, not 5, too small. But here's where we're at. If you put your stop loss at the very closest fractal, which again, I'm willing to consider as long as we have a ATR, cushion personally, that's mine for me. You don't have to follow for you. But even if you put your stop loss here, the widening of the spread at this point alone, okay, this is a minor, this is not a major. The spread can fluctuate depending on the broker quite a lot. This even, and I'll zoom in, try to get it as big as possible. There we go, I gotcha. If you put your stop loss even at the most recent swing low, there's a pretty good chance this knocked you out. Just in the spread widening. Just that alone. Period across the board. Because the spread does, right? This right here is that kind of gap, that slippage. That's what that is. Okay? If you re-entered, for example, and you try to take it anywhere in here and you try to put it directly at the base of that candle, which again, one of the members in the group were following along, was doing comparable things. Again, no blame, no shame. We're just discussing and learning this together. What happens? You're going to get knocked out a whole bunch of times. Over and over and over again. Which means this stop loss that you're trying to do with so tight and so amazing, if it can't afford a consolidating period like this, and this brings in both directions, I don't personally think it's a great stop loss. If your stop loss cannot afford a little bit of room for the market to digest some reasonable news, I'm not talking a flash crash, I'm talking reasonable news, and reasonable is subjective, I know. If your stop loss cannot afford, for the most part, the majority of the time, to digest a session crossover, I know some pairs are more expensive and swaps and what have you. If your stop loss can't afford a gap, if it does happen, again, some of them are extreme over the last 20 years, but the majority are reasonable, right? They're within a reasonable amount of ATR. It's my opinion that if you're not going to have a long-term sound trading strategy. So back to this whole concept here, these are the top considerations I would consider before I decided where I want to put my stop loss.